Zoltan has a lot of things to do, so we're really happy that he's here with us. Adam could not be here with us, unfortunately. He's uptown, I think. But of course, Adam, we're really glad you're here with us as well. And people are still strapping in. That's great. My name is Jay Pocklington. For all of you who don't know me, I'm leading the YSI's Young Scholars Initiative. And if you looked at the program, right after we're done here today with the session on the future of the dollar and the challenge of the dollar, we'll go upstairs for all of you who are here, and all of you who are somewhere else, you'll have to find another party, but we're going to go to the rooftop and sort of cheers to 10 years YSI. So really glad for all of you to be here. That's great. So thanks again, and for all of you to show up. I think we have a quick round of introduction, basically to just say what this topic is about and how this workshop came together, because tomorrow we're going to actually dive into the conversations that we've had here. I would like to give a warm welcome to my co-organizers, Elham and Alaksandar, who in a moment will also welcome you. They have both been teaching on the subject, and what the initiation and the idea for this workshop is to bring Sasha's students who are at NYU Shanghai together in a conversation with Elham students who are here based in New York City, all over town at Barnard College and at NYU as well. And to bring this conversation together about the Chinese financial system and the American financial system. And we're, of course, using the current developments as a really wonderful, a very interesting and inspiring conversation about the future of the global financial system. So that's the topic of today. Obviously, I can preface this in a long way, but I think the question at hand is the question that we hear every 5 years, every 10 years. Also with INET, the initiation of INET has come together with a crisis that has been born in the financial system. And Rob Johnson is here, obviously, as the founder of INET and the head of INET, to speak to us in a second. But we're here today to talk in the provocation that Zoltan has put out on the future of the dollar, and in a piece that he's done at Suisse on what he entitled Bretton Woods 3.0. And we're here to maybe recap what is Bretton Woods 1 and 2 for everybody who doesn't know. I'm sure you do know. But I think I would just like to now also give Rob the opportunity to say one word of welcome. INET has indeed been at Bretton Woods at the conference 2011. We've thought about the design of an international order and monetary system. So Rob, where has that journey taken us? And thank you very much, Rob, for being here with us today.
Congratulations on your 50th anniversary. It's been one of the most satisfying connections in my work. Don't you like to see how much you all have blossomed? I have young children and grandchildren.
I'm so sorry. Could you speak up a little bit? It's hard for us to hear on the Zoom.
Okay. I'm not an opera singer. Jazz guy. But anyway, I would say that I look forward to growing leadership that this community is spawning, because I have children and young children and grandchildren, and I start thinking about who's going to watch out for them. So everything that I enjoy here has multiple dimensions, both my intellectual nourishment and the protection I imagine providing to those young people in the not too distant future. I am fascinated, partly because I worked in the realm of financial regulation and as a financial speculator in my own career, to see people, which I call yearning for order. Because what it felt like to me when I studied the economic history, the breakdown of the gold standard in the 30s, was that people had to wait quite a long time and through World War before they could put something together we call Bretton Woods. When we started INET, the first conference was at Cambridge University, King's College, where Keynes and Hayek teed off on the roof together. And then the next year was at Bretton Woods, New Hampshire. And it's out of what you might call reverence for the sensitivity to global design. And once again, not necessarily thinking it was time to have that meeting. It's nice to allude to that awareness and then wait for things to unfold. I would say at this juncture, when we got through the great financial crisis with bailouts and so forth, we did ignite a lot of hostility. I'll refer you to all to the Audible podcast series, about 8 hours by David Sorolla, called Meltdown. Because the meltdown is not of the financial markets, it is the meltdown in trust and belief and expertise and governance that we are grappling with severely today. As people felt as jurisdictions said that who's got paid. But there's not a lot of social balance in that bailout, nor particularly profound reforms to stabilize the system. At this juncture, I think the interface that you were talking about with US and China is fascinating. I think the kind of things that you've been illuminating, you have very fine, sensitive texture of institutional things. It's not just an abstract piece of math. You're living in the middle of the plumbing. That you're in a very good place to explore. But I don't, and I think the yearning for order is what inspires this meeting, the writing. But we're all going fishing, we ain't caught the fish yet. Yeah. And I think there's a lot more turbulence before there's an after party. So let's have a party tonight and pretend it's the after party, because I know you're going to help us move down the road. Thanks.
That's great. Thank you, Rob. So now let's hear from. Thank you, Rob. Let's hear from Elham.
Thank you. So thank you all for coming tonight. So I was thinking about what to say. And then I realized that global dollar funding and YSI, they have a few things in common. For example, both of them, they are stable, and they are especially to see their resilience and stability during financial crisis. And the second, or during the crisis, including financial crisis. And also the second one is that they are the best system we have in the world. So when it comes to Fed, I think we do owe the stability from the Fed, because Fed has engineered the stability. I think when it comes to YSI is for INET and INET support, and also people like J. Pocklington and Heske, and also when it comes to the intellectual foundation is Perry and Zoltan. So I really think that we are in a very good place, and thank you so much for coming to this event today and hopefully tomorrow.
Hi everyone, thanks for coming also from me. I just want to say that for me, now it's a year and a half of this strange adventure of talking money view to people in China, to students in China, and it's been a really interesting development. And tomorrow, those of you who come will hear much more of that. It's just so exciting that we are all here, that we have this conversation, that in fact all of these questions that we have been asking already for a while are now opening up in a new way, and I think Zoltan's piece helps us really understand how much they get opened up. And I look forward for this day and a half of discussing these things.
Can I interrupt for a second? I looked over my shoulder and I recognized a major initiative in my presentation. Guiding Light Formation of the Young Scholars Initiative, and a person who I think has integrated the awareness of institutional finance with the more abstract. Sitting to my left here, it's Barry Miller. This man invested so much energy and was so inspiring at the outset. Everything that you said, I see it.
Oh, what a warm welcome to all of us to the sessions. That's really great. I want to just add to it because Adam is on the call and Harry is here too. Adam, you might recall that you inspired with your Wage of Destruction my master thesis on Hamashacht. It's entitled Behind the Curtain of the Old Blizzard, German recovery of 1933 to 1937. And of course, that is sort of trying to marry the views of Perry with Adam Tooze's insights at the time. I didn't know that later on that they would meet and become close friends and actually integrate their frameworks really well. So I'm really happy that I sort of maybe personally anticipated this, but that's really wonderful. And also that we can now continue this book into the future because the history repeats itself, and I'm really just happy that we have all these people together thinking about the past, present, and future. And what better place to be here than in the middle of Manhattan in the INA office. So welcome once again. So let's get started. We're talking Bretton Woods 3. So that begs the question of what is Bretton Woods 1 and 2. Let me just quote very briefly Zoltan from your report. And that is, Bretton Woods 1 was a monetary order based on gold, with the backing of gold. Bretton Woods 2 was, of course, after the breakdown of Bretton Woods 1, the backing of, say, U.S. treasuries, but fiat essentially. So there was a backing of that. And now what provocation is, what you're saying that might be in the picture, is that the future of Bretton Woods 3 might be the backing of outside money. So inside money being treasuries and outside money being commodity-based system. We'll get into that in a second. I'm going to ask Zoltan to explain what he means by that. But I would like to say that, of course, the Ukraine crisis has sort of put into focus two major geopolitical events, I think, that we want to have at the center of our conversation. Number one, the invasion of Russia and Ukraine has induced the G7, the West, into sanctioning Russia, and therefore put into the table that U.S. dollar liabilities primarily, but any liability of the West can be in danger if it's not in direct control of the country. That puts a major question around how those liabilities will be used in the future. That's at least how I read also Zoltan's piece. The second question is that the commodities market used to be a global market, very integrated, and that seems to be now bifurcated. So this is a question that I think is at the center of the conversation, and then we can sort of imagine into the future what consequences we have. And how I imagine this conversation to go is that we have first Zoltan explained to us how he sees Bretton Woods 2 working, and then the consequences of the current shock for Bretton Woods 3. But we have maybe a check in the room, maybe not, or virtually, that Adam Tooze can actually tell us whether there's actual evidence for the claims that Zoltan has. Do we actually see this conversation going in this direction? Or how far along are we with 6 weeks, 8 weeks down the road? So I don't read Zoltan necessarily as somebody who sees himself as a prophet, but I think you've opened up a space of conversation. We might end up somewhere in this direction. There might be a thrust in this conversation. But I'm really interested also from Adam to hear what is the actual institutional challenge to move away from a dollar-based system in this sense. So we can talk about the actual challenges. So it might not be as easy as the theory that Zoltan is putting forward. So with that, I think Zoltan, welcome again for being here with us, and thank you for that. Could you just walk us through Bretton Woods 1, 2, 3, and
yes,
how did that start?
I have to correct you. I'm not a prophet. I'm a disciple. Paris disciple. And also maybe I'll preempt Adam's answer too. There's nothing to see at the moment, right? This is, it's tough to make this pivot. But I think something will come out of it.
So sorry, Zoltan. This is Heske. Yes. It's just a little hard for us to hear on the Zoom. I think either try to speak a little louder or move closer to the mic.
And we might have to just speak up.
Can you hear me now?
Yeah.
Goes in and out. You're not close enough to the mic, basically. Sorry.
Where is it? Oh, it's right there.
Maybe if you stand up. So they always talk in finance about P&L.
Yes.
Profit and loss.
Yes, profit.
Let's move a little bit closer to the mic.
Yes, so okay. So
But Heske, we're hearing me fine, right?
We're hearing you, Jay, much better than we're hearing Zoltan. So maybe.
So.
Okay, we're gonna switch places. Yes.
But that's the mic right there.
Yes.
It's the same, yeah. It's quite good. Yeah.
Yes. So I guess the important point, what I just said is that there is nothing to see in the data or the flow about Bretton Woods 3 yet. I think we will, gravitate toward a system like that. Bretton Woods 3 also doesn't mean that it's over for the dollar. It's obviously not the case. But, would I say, could we potentially be at peak euro dollar? Yes. If you imagine Paris hierarchy, we have a very steep, well-entrenched dollar system, and then we have a flat renminbi system, but this one is probably flat. They are going to coexist. This is a coexisting vision. You wanted me to describe 1, 2, and 3. I mean, 1, everybody understands how it works. Dollar, gold. Bretton Woods 2 was I would say a system that grew out of peaceful coexistence. So there was the petrodollar, we sell you oil, you give us dollars, we recycle dollars into treasury securities. Then we dollarized Southeast Asia, but then those pacts became endangered and they were broken because there were not enough FX reserves. So then the lesson was we need FX reserves. We need to cover at least 1 or 2 years worth of current account deficits, whatever current account needs we have. And then we turned that into a mercantilist vision. China, we basically can accumulate more reserves than we need because we actually need to depress the value of our currency. And that's actually around the time when this notion of Bretton Woods 2 was conceived by Mike Tooley and David Foulkes Landau at Deutsche Bank. And this is a peaceful coexistence basically that some have called Chimerica. They sell us stuff, we give them dollars, and they recycle those dollars into treasuries. And that was the world that we have lived in, and it was great until it wasn't. I mean, it's not like it didn't have any bad consequences. The housing bubble kind of grew out from that, and the rest is history. But again, I think at a deeper level, the Bretton Woods 2 system is a system where dollars mean not just treasuries, but also euro dollars more broadly, right? So a lot of these FX reserves are not just recycled into treasury securities, but they are, lending the FX swap market where, central banks sell dollars and get euros and yen, and then they, that's what an FX swap is. You sell these currencies spot, you get something in return, and then you commit to repurchase those dollars in the future. But then if you're a central bank and you manage these reserves, if you swap out of dollars into yen, euros, you get to deposit those at other central banks. I say that because what happened with the reserves of the Central Bank of Russia, I mean, their assets were frozen. What does that mean in an institutional sense? Russia didn't have any treasury securities, so everything they had was in the euro dollar market. Euro dollars are stateless money, right? Stateless money, right? Did I say that right? Kind of. I mean, bankers created and then private money, semi-stateless, because it's like bankers' money, right? I mean, they create it, but then when you do these FX swaps, the on-balance sheet manifestation of an FX swap is that you instead of having a dollar at the Fed, you have a dollar at the Bank of Japan or euros at the Bundesbank, what have you. I say these details because the seizure of these FX reserves were not seizures of dollars per se, because that's an onshore thing, but they didn't have any. This is basically a seizure of not even euro dollars because they swapped euro dollars. So this is a seizure of deposits at the BOJ and deposits at the Bundesbank. And again, I want to emphasize this because this is basically a seizure of G7 inside money, if you will, right? So Bretton Woods 2 is about inside money in the form of treasuries. Bretton Woods 2 is also about inside money in the form of all 7 G7 claims, all sorts of G7 claims, whether it's a central bank deposit, whether it's the debt of sovereigns of the G7, or if it's deposits at financial institutions at large financial centers. And so in your summary, when I say that, we had inside money, outside money, which is gold, and then we had this, then we abandoned the gold standard, then Nixon closed the gold window, and then we had, fiat money, in Fed we trust. And then we had Bretton Woods too, which is all based on inside money, treasuries, and also more broadly G7 inside money. I mean, I'm sure, because I hear this from either it's a client like an FX reserve manager, or investors that talk to FX reserve managers. There is discomfort that this idea that this stuff is yours and then it's not. Okay, so when you think about the system built on outside money, that's where no one is in control of the outside liabilities, for as long as it's in your own basement, to a system built on trust, and then a system built on inside money, but where your asset is someone's IOU, and they either perform on that IOU or don't. When you kind of go from this system to this system back to something, again, I think when you think about this new concept of outside money, I mean, I do believe that gold is definitely going to play a bigger role in reserve managers' asset allocation going forward. We've seen that shift already ever since 2005, and especially after the great financial crisis. That shift from treasuries to gold accelerated. I mean, it's in the data. It kind of plateaued, but I think it's going to have another leg up. Second, if I am right about shortages, I think we need to be cognizant of the fact that today the problem, in 1997, the problem was there was not enough dollar liquidity. So where do you get it from? Today, everybody has dollar liquidity coming out of their ears, right? The problem is you can't buy wheat, or there's no neon for chips, or there's not enough chips. This is a shortage of stuff. When money doesn't buy you anything because you can't buy anything with it, right? So I'm sure that at some high levels, when people think about reserve management, the notion of a reserve is going to change too. So instead of sitting on liquidity, maybe you should be sitting on piles of stuff. Like India is asking all its states to build a stockpile of coal for the next 2 years. Things like that, right? Chip supremacy. Who gets what in terms of rare earths, lithography machines, things of that nature. I think countries are going to spend more on these things. And so, again, the notion of pure inside money as reserves to going a bit more toward gold, because it's a monetary thing, and then a bit more toward commodities in general, yes. But also, figuratively, outside money in this context of away from the dollars into something else means outside in that, this is a bit like Janet Yellen's concept of friendshoring. We don't offshore anymore, we friendshore, which means I don't offshore to you, I offshore to you because I know you and I trust you. So outside money in this sense is that, a system where renminbi is more important because, some commodity exporters are going to invoice commodity sales to China in renminbi, or will only sell commodities to China, if you have some iron curtain and east and west and trading block. It's outside money in the sense that it's outside inside money, but it's outside in the sense that it's not dollars anymore. So I trust them. I don't trust you. So again, I think we are probably at a fault line. I think things will change. This is not going to be an overnight shift. I think it's not immediate, it's inevitable. And it's going to take time. 5 years from now, when we look back at the data, I think we will see a number of inflection points. And then maybe a fourth idea I would say is that, again, mercantilism is also going to be rethought, because again, a lot of central banks have a lot of dollar assets because they want to keep their currency weak against the dollar. But again, if you go into a world where it's not the competitiveness of your currency that matters in terms of your access to markets and your export market, but things like sanctions, probably again there is less reason to sit on piles and piles of treasury securities suppressing the value of your own currency. So I think these are all things we need to think about, and there will be consequences. So that's how I would summarize it.
So that's great. So let me just point out for those of you who are not in the weeds in this conversation, I think an important point. So Zoltan says Bretton Woods 2.0 is based on the sort of mechanism of a global bank, an offshore a bank that's issuing or on its liability side able to sort of take a loan on its asset and expand its balance sheet with US dollars off on its liability side. A corporation who's asking for that loan will then use that money probably for a commodity producer to buy goods denominated in US dollars, and these dollars would then be recycled to buy US treasuries. We can talk about the consequences and the benefits of that particular mechanism that happen for the US. That means a number of things that the US can we can talk about those benefits in a second. But I think this is specifically, this recycling mechanism is something that might break, because right now we see, if, for example, the hypothesis, commodities are no longer invoiced in dollars, there is no need for a offshore dollar creation and euro dollar creation. So where something else has to happen, something else has to be created. So this is now something that we can sort of say, is there a direction for Adam? Do we see already the first indication of this sort of moving away from this sort of invoicing of commodities in dollars, and therefore the need for a new type of sort of clearing, or a new type of, say, creation of another type of sort of, should I call it euro renminbi market emerging? Do we see any evidence or any indication for that?
Thank you, Jay. I hope you can hear me okay. Can you hear me okay? Yeah. It's a real pleasure to take part in this panel. I'm sorry I'm not there. I'm recovering from COVID, and it's better to make a relatively quiet evening of it at home. And I don't want to speak for very long, because you've got Perry sitting right there, and I was anticipating having Barry Eichengreen in the room as well, which would have made it all the more imperative for me to speak briefly. So let me try and pick up some of the threads and address some of the issues that you're raising, Jay. I like this version of Zoltan's argument better in some ways than some of the earlier versions. I like this sketch version a lot. It's fascinating. It connects so many dots, and I think it's brilliantly illuminating at that level. There's no doubt. And I really like the way that you played with Perry's schema and created a commodity analog to it. And I thought that was very clever and very thought-provoking. I guess my questions are really those, as much as anything, actually, just of a historian, to be honest, a historian who is very interested in the relationship between past, present, and future, and so is in the same sort of game, but as it were, comes to the writing, and Zoltan's writing, apart from anything else, is just fantastic to read. It's so imaginative and unfettered in some ways. It's really kudos for what you do in the medium you do it in. And I'm kind of curious about where it sits itself and what it's symptomatic of, that mode of writing. But to the substance, I mean, as Zoltan says, so far the trends are just not there in a very, very pronounced way. There's a lot of strategy outlines which seem to suggest the possibility of schematizing what's going on in the way that he does. I don't think the framing in terms of Bretton Woods 3 is very helpful, because as Zoltan conceded this evening, or just said this evening, his vision is not, after all, a holistic, unitary one, but a pluralism. And if Bretton Woods 1 and 2 were about anything, they were efforts to craft unitary monetary systems, centered initially on gold backed by the dollar, and then all of the other currencies in the world organized as satellites around that hook. And then even in the Bretton Woods 2 case, you could say, well, the initiative was in a sense unilateral from the Chinese side, but the effect and why it was dubbed Bretton Woods II was that it essentially organized a very large part of the global economy under this axis of a neutralized euro-dollar zone, which then turned out to be the thing that blew up in 2008, and a old school 1950s style peg almost of the Chinese currency against the dollar, using exchange controls and other mechanisms to make that fit. And Bretton Woods 3, in the form you presented it here this evening, Zoltan, doesn't to me have the character of either of those two previous orders. It simply is a partial model for organizing power and money that will emerge in one zone under the pressure of the increasing disintegration of the global power system, and may or may not in that zone take on a quantitative significance that we will be able to gauge when it happens, but doesn't in that sense, as it were, add up to an analog to the previous Bretton Woods models. And that may be just embroidering on what you're saying, and we may be agreeing by way of disagreeing about the terms, because if what you're describing in my terms would be something closer to the multipolar fragmentation which we see, which however would mean that in quantitative terms, a huge piece of the global system remains essentially in the post-1970s mode of the dollar-centered world, which is neither Bretton Woods 1 nor Bretton Woods 2, but is something else. And that's not really described by your vision, and that's not your aspiration. And I guess the question there is what holds that together. And on this, I would respond to something you said, Jay, which is you asked me to describe what the institutional anchors of that neither Bretton Woods 1 nor Bretton Woods 2 world is, which describes most of the world's economy. And I would say it isn't really so much institutions, certainly not macroscopic institutions that anchor it, but a series of commercial practices, marginal commercial advantages to doing business in dollars rather than doing business in other things, which then create network effects, a kind of Gita Gopinath type story for that dollar world. And that is extremely resilient because it's kind of a blob. It doesn't really rely on highly structured institutions. It relies on just commercial logics which drive it, which make it a good system to operate in. And it has the stewardship of the ever generous Fed at the center, which twice over in 2008 and 2020 has proved itself to be a very generous provider of liquidity to that zone. So that's kind of what holds it together. It's unlike either Bretton Woods 1 or Bretton Woods 2, and Bretton Woods 3 that Zoltan's describing seems to me to be a partial regional power block kind of model around which this amorphous world, which is neither Bretton Woods 1 or 2, but is private finance backed by the Fed in an ad hoc way, and maybe the ECB at certain moments now, continues to exist. And then I want to come to a final point, which was really the main burden of my intervention, which is in this conversation that started, I think, maybe with a newsletter I wrote in reaction to one of Zoltan's brilliant notes, which was really me putting my historian's hat on and going to two comments you made, Jay, in your setup. And you said two things. You may not even remember it because I think they were offhand comments, but they're nevertheless, for me, very telling. And you said two things. You said, first of all, this debate about the dollar, we keep having it. Every 5 years or so, we have this debate about the dollar. And then another thing you said was, well, then history repeats. And these are just throwaway lines, I'm sure, but to me, that's actually what I'm obsessed about thinking about, is precisely those two issues. Like, does history repeat? And this would have been my question to Barry Eichengreen, who, after all, has a strong read on the future of the dollar, depending on a strong read of the history of the sterling zone. Should we expect that kind of succession model to work its way through? And to come more directly to what Zoltan says and what you're describing, Jay, like, why is it that we keep coming back to this dollar question and its future? And why do we feel compelled to produce quite grand, dramatic, at times quite Gothic visions of what will come next? And to me, that's indicative of a really profound tension in the world, which is a huge disproportion between the world of commodities, the world of trade, which is multipolar and complex in the way that Zoltan's grappling with, and the world of the euro-dollar system, which is to an astonishing extent unipolar still. And that is a tension which is, well, it's puzzling, it's surprising, And at some level, it feels increasingly illegitimate, and there are going to be people who say it's illegitimate. And it seems to me that it's out of that tension, this weird disharmony in the world between a multipolarity of trade and population and GDP, where it's centered, and the extraordinarily unipolarity, essentially pyramiding in Perry's terms to the Fed as the ultimate provider of dollar liquidity in the last instance. It's that tension which in us sort of creates this desire for a resolution. It cannot be that this persists. It feels as though we need to say to ourselves. And we look for people who are saying it cannot persist, and you find them, like people like Putin ever since the early 2000s have been saying it cannot persist, this can't go on. And that, it seems to me, needs to be taken seriously as a discursive field that continuously generates, as you said, Jay, every 5 years or so, this question comes back of what is going to give? And I think what we need to check in ourselves is the assumption that anything necessarily has to give. It may, and this is where, as it were, the philosophy of history and more mega macro framings come into play. What are our assumptions about the future development of this order? Zoltan is saying, over a 5-year time horizons, he thinks certain pieces, there'll be inflection points and certain pieces of this will shift. My sense is, I understand why you would say that. There are clear intentional strategies at this current moment. But the conclusion that that leads us to Bretton Woods 3 seems to me precisely the kind of characteristic overshooting that we expect from these kind of discourses. That isn't where it takes us. It takes us to a much more partial, much more contained, much more limited kind of system, not really ultimately analogous to either Bretton Woods 2 and certainly not analogous to Bretton Woods 1. So that would be the kind of burden of my thinking so far on this, is that we also need to develop an awareness of our own unease with this patent and massive disequilibration. And it's not abstract. Like, this is also a source of power. Ultimately, it's not unfettered power, because the Fed's hand is forced more often than not in these crises. This is not some simple power that the United States can wield, though it can, of course, choose to sanction at key moments. But we should guard against the impulse to believe that what in the end seems illegitimate, disequilibrated, hierarchical, will in the end resolve itself in some way which is different, and that into something new. We will leave the phase of the interregnum to enter into a new regnum, a new structure. And I'm actually just skeptical about that as a description of the current moment right now. I don't really think we've yet come to terms with multipolarity and true complexity, which would mean that we need to give up the language of Bretton Woods. And we would recognize what Perry's describing, but we would no longer insert it into that kind of holistic narrative. I'll stop there.
Thank you. Thank you, Adam, for those really insightful comments. I think that really advances the conversation to some degree. And I think I would like to just maybe bring it a bit more to a concrete set of questions that I think I would like to maybe have Zoltan and you bounce back and forth. The reality is that sanctions against Russia by G7 take out a major commodities producer on a number of fronts. It hits, of course, Europe at a broadside that we have not anticipated before, but it has vast ramifications in the energy market, or in the energy market and in the commodities market. So this, if this is upheld, this particular set of sanctions is upheld, this must have some sort of movement, some sort of institutional shift that has to occur. So the question then is, maybe between the two of you, maybe we can have quick answers, is how does that particular problem now manifest itself? How do we see that playing out?
Can I just say something? I don't think that this is about Russia or Ukraine or Russia and US. That's a spark, I would say. And then there's all this other stuff. So, there's great power dynamics. I mean, ever since President Trump, the U.S. approach to China is on a bipartisan basis has changed completely, right? So I think, and again, Bretton Woods 3 is, how Perry says that, finance is about discounting the future, and then markets overshoot, why? Because people are emotional about their views and things swing around. So, Bretton Woods 3 was one of those, when I started to write that, it was a very emotional, like something just pours out of you. I mean, if you're in finance, you have to have a view. What is the Fed gonna do? What is the next 5 years going to look like? If you design a portfolio today about, you need to be positioned if the world is becoming more fragmented, more inflationary, and so on and so forth. You have to have a vision about where the world is headed over the next 5 years. I mean, that's just the way it works. So I don't know. You just try to kind of foresee what all this basically means. Not again, this is not just Russia, Ukraine, but also, Russia-China special relationship, conflicts about chips, conflicts about NATO, so where is this going, right? You probably have Brzezinski's book about grand chessboard and, the whole Eurasian. Is this about that, right? If yes, then this definitely is probably about a new pyramid growing from a flat sheet of paper. And so I think this conversation about Bretton Woods 3 is not just about what you did to Russia. So, we will change the way we run reserves. I think this is something much broader, much deeper. But again, this is something we need, at least if you're in finance, you have to have a view about this, because I think this is going to have huge implications for the level of interest rates, level of inflation, commodity prices, and whatnot. So I think that's another important element of the question.
So there's a fault line very clearly here.
Yes.
So there's an inflection point. Adam, what do you think about that?
Oh, well, I very much agree with Zoltan that this is not about Russia. For me, Zoltan gestured to Trump, and I think then within the Trump administration we can, divide up. I mean, the moves in the phase 1 trade deal to start specifying trade policy in terms of quotas of soy imports and so on were pretty remarkable in their own right. They actually point in Zoltan's direction. But the key thing is clearly the microchip war, because what you do there is you tear out of the broader economic context one particular absolutely strategic component, which then reveals itself to contain truly bottomless levels of complexity, and make that into this single item around which entire structures of power are organized. And that is disruptive in a way which I think we are again and again in so many other fields now having to come to terms with. And it again goes to one of Zoltan's points, but it's implicit in what you're saying, Jay. So Zoltan says they're going to stop holding reserves in terms of currencies, and then they're going to hold reserves in terms of stuff instead, which makes perfect sense until you actually try and start specifying what stuff to hold reserves in. Right? Because if you hold it in gold, it's basically just money stuff. So that doesn't really count. That's not actually really, it's a different sort of money, admittedly, but still it's basically fungible. You're going to trade it for other things. You're not going to use it as such. But when you start acquiring stocks of grain, for instance, or stockpiles of microchips, what you're actually doing is entering the domain of the calculation debate. You're actually entering the domain of trying to re-specify the functioning of the economy, no longer in fungible, abstract quantities measured in terms of currencies, which is why holding currency reserves is so attractive, because they're fungible, especially if they're dollars, and instead actually trying to basically spell out some primitive input-output matrix of what you think your society's basic needs are, or what its productive inputs have got to be. And as soon as you start doing that, it gets, like I was saying, it's not microchips, which are just like mind-bendingly complex because they're so flipping tiny, but mind-bendingly complex because the input-output thing was always mind-bendingly complex. And that's why we thought the calculation debate, was a bit of a dead end. But that's where you end up, and that's what the Germans are trying to do right now when they face the possibility of a sudden gas boycott. They're actually having to do an input-output matrix, improvise the knowledge necessary to figure out which bits of the German economy will grind to a halt, and having to do that in the face of, the knowledge isn't there, the input-output matrix isn't there, they don't have the models, and they're doing this in the context of hotly contesting interests. In other words, everyone has their own input-output model, and they're all offering it to you, and you've got to decide. And you can't use the market to arbitrate that, which is what the market normally does, right? Everyone has their input-output model, but you use the market to arbitrage the different opinions, and then you settle on the price. They don't have that anymore. If what their only arbitrage is politics, and they're literally trying to figure out what percentage opinion poll will we take if we cut off gas to Ludwigshafen. That's a calculus that we don't have a lot of experience with, and it's hugely challenging. And I think, therefore, Zoltan's Bretton Woods 3 concept captures it. I just think that the label's terrible. But the shift that he's describing from money to stuff, and then into the bottomless pit of complexity that's opened when you try and look at stuff, I think does very well capture the dynamic we're feeling here. And of course, climate change and energy transition poses exactly the same problem there, because if you look at it from a macroeconomic point of view, it looks trivial. As soon as you start looking at it from the point of view of physics and engineering, it's absolutely anything but.
Well, great. I think I'm looking at the clock, and I think we have about 20-something minutes left. And I would like to really welcome the people in the room and on Zoom to sort of, I know we won't get to many questions, but I would like to welcome anybody who has something. Maybe comments very quickly, maybe Rob or.
Can I add something very quickly? We can, Adam. We can work on the label.
Oh, excellent.
I like Bretton Woods 3 because why not? I mean, it's successive, But the way Bretton Woods 3 is very much about Russia is that if this is an inflection point and you start doing things differently on the margin, the invoicing question of what do you get paid in if you sell commodities? Russian commodities are the sale of the century.
Yeah.
I think Christia Freeland had this book, Sale of the Century, about, right? So this is the sale of the century if you need commodities. So this is a bit like, like Russia has a bunch of stuff to sell at deep discounts. Urals are selling at a $50 discount relative to Brent and WTI. And we probably all understand that, the market for that is either India or China, because you see the flows there. And so, that stuff is going to be invoiced in renminbi. And, then the Saudis are wondering, well, that's my biggest market that's growing the fastest, and they don't want to buy oil from me anymore. Well, I need to give them an incentive. And so you see in the headlines things like, well, okay, we're going to give you, China, oil at a $5 discount relative to Brent. And we are also thinking about invoicing all this stuff in renminbi, which is important because, again, the petrodollar was born right there, Saudi Aramco and OPEC and whatnot. And so Bretton Woods 3 is not about Russia, but the birth of that system, if we are right, I think is born in this conflict because of this opportunity. And, China is mercantilist, so they will extract a pound of flesh. And so maybe that's the point at which you start invoicing things in renminbi. And that's already happening. Again, everything is just scale, ramping up. I remember when I first came to the US in 2000, I was, and I was looking for an internship in DC, and I was, like, what am I going to intern about? Like, what should I do? And I remember, like, writing all these emails from Hungary, called Dear Congressman this, Congressman that. Like, I'd like to research the impact of China's admission to the WTO. 2000. Okay, well, it was important, it felt like. But little did we know that that's going to end up in like $3 trillion of reserves in the span of 8 years. I mean, in 8
Zoltan,
years, a lot of things can happen.
Zoltan, do you think it's significant that that the difference is that one difference is, I'm going to use your language because hell, let's not argue, but the difference between Bretton Woods 2 and Bretton Woods 3 is that in Bretton Woods 2, China functions as a export economy fundamentally, whereas the basic logic you've just outlined for Bretton Woods 3 is that China functions as a universal market for commodities, right? So it shifts from being an export-driven story for China to a import-driven story. And China is significant because, unlike the US, it possibly has a near universal demand for imports. Like, does China need to basically import everything to some degree, whereas the United States was never quite like that? So in a sense, could Chinese import demand be the commodity style universal common denominator? Because there's so many of them, their economy is so big, and they actually aren't terribly abundant in raw materials. They can serve as the universal arbiter of this commodity structured, bit of the world economy.
I don't know. I think if I understand your question the right way, you're saying that they have to import. Okay.
Potentially, they could import everything. Yeah.
Yeah. Well, look. I mean, Rome wasn't built in one day, and then when people bring up the current account deficit structural versus current account surplus structural, not all current account items are, deficit or surplus. Some are deficit, some are surplus in the aggregate. So again, Rome wasn't built in one day. Deficit items you start paying in your own currency, and then ultimately, I mean, China, you can't invest and not consume forever. I mean, I think that's also a big life cycle of a country, right? We over-consumed or under-invested, and they over-invested and under-consumed, and I think that will have to pivot at some point. That pivot, I think, is going to also flood the world with more stuff. Look, if you think about friendshoring, for example, right? It's inevitable that China will export less. I mean, if we sanction Hikvision and whatever we sanction, coming out of China, Huawei, whatever, right? If we go down that path, it's inevitable that they will end up with a lot of excess production capacity because they're losing markets because of sanctions, right? So I think it's, again, discounting what you see in the present, what it means for the future. I think this is, that pivot kind of forced. Mm-hmm. But again, as that happens, I think, I think that's how you scale the Bretton Woods 3 concept. And again, I think Bretton Woods 3 is also thinking of regions and great power politics. It is also, the monetary anchor of One Belt, One Road. Kind of.
If you think that's
maybe it's my upbringing on the other side of the Iron Curtain, and now here on the other side of that curtain. But you have to jump curtains in my life at least every couple of decades. So you just naturally play with these thoughts because it's like that.
We'll just leave that point standing in midair, and while you collect your questions, I'm just going to give Rob and Perry a quick opportunity to give a comment on the discussion, if you like. If you have something to say, and then we go to questions.
Okay. I've been following particularly personal bankers trust as well as from working in relation to China since 1989. My wife was the head of Japan House, the term system through the 1980s. So Asian dynamics, I think, are very powerful. I agree with you 100% when you said this isn't caused by Russia. I've seen things like the 94 devaluation of the renminbi, reorienting the patterns of foreign direct investment. It became increasingly apparent to the world at the time of the Chiang Mai initiative that something was going on, which you might call trembling about the dollar system. I saw Chinese officials come and consult with me about the SWIFT network and whether they could get shut down or shut out. I watched all kinds of tensions, and it feels to me like Xi Jinping can see that when the Soviet Union collapsed, we did not choose to dismantle NATO and build them in to the EU. So there is a punishment, isolation, maybe the need for a bugaboo so that you can keep the military industrial complex flourishing. But even more intensely, I saw the Chinese from the century of humiliation feel like they want to be a partner at the head table. And America would be naturally resistant to that. And I'd encourage you all to have a look at Orton Shell and John Delury's book, Wealth and Power, because it's about the tectonic plate crash of two philosophical systems coming together, Cartesian Enlightenment and Taoist Confucianism. In contrast, we move from a G7 to a G20. As Brzezinski said in 2010, everybody's awake now about the importance of politics in these social designs. But as this has moved down the pathway, I see Xi Jinping's will in a cost-benefit analysis in the short term. I think he made a huge mistake siding with Vladimir Putin. The consequences for his economy and his society, and he's under a lot of pressure because of these decisions, right? But the key thing that you said was this wasn't about Russia. I think Russia was about this. I think if Xi Jinping hadn't sided with Putin, we wouldn't be going through this right now. And I think that, what I say, both are symptoms of that US-China clash. And it can't be because of the threat of climate change, just a clash. There's got to be kind of a cooperative dance and a balancing of respect. And as you alluded to right at the outset, when Donald Trump did not criticize the American government for the lack of adjustment assistance to the large segment of the population because of automation and globalization, and chose to demonize Mexico and China, he put the current people in power into a very defensive position where they have to act tough too, and Xi Jinping cannot tolerate you acting tough. So you're in an unstable dynamic. Yeah. I don't know if we have a Bretton Woods 3 because that looks like an end game. I think we're still just devolving and disintegrating in Bretton Woods 2, but I like the fact that you're trying to look around the corner.
Wealth and Power. There's a book, Wealth and Power, yeah. We'll circulate it in after the session. Harry?
Well, Rob has sort of emphasized the politics part, so I'll emphasize the money part. I've just finished a book called Money and Empire, which is about the balance between those two. It's a biography of Charlie Kindleberger. But
got me into it.
Yes, So, and I think also Adam Tooze has a little story there too. What he was saying there about the conflict between the logic of money, which is unitary ultimately, and the logic of politics, which is not. And that this is not about cycles. It's a constant contradiction that it has to be managed. And that management may go through cycles conceivably, but it is a management problem, and we're facing some challenges to that at the moment. That's the first. So I'm aligning myself with Adam on that point. That's the frame that you need to begin with. On the precise point about the monetary, there's sort of two aspects of what Zoltan is saying that I think it's useful to untangle and maybe treat separately. One is China, that he says thinks the future is a China future, that it's about the RMB. I have thought about that and written about that in the past on its own. The second thing is that it's a commodity-based money future, which is a second point that I have also written about, but a long time ago. Benjamin Graham. I'm just going to put another book in your mind. Benjamin Graham, the great bond investor, really, in the 1930s. Before Bretton Woods, he had a proposal for commodity reserve currency. As an international currency that would replace sterling and the dollar, and it would be genuinely international, it would be backed by warehouse stores of basic commodities, and there would be an index of these commodities. And this was a sort of precursor to Bretton Woods. And in fact, he tried to get this proposal into Bretton Woods. And there's a whole story about that. And I wrote an article about that. It's on my website. And I actually got a little award. The Street Economics Society liked that little paper. And it's called A Bridge Between Goods and Money. A bridge between goods and money. Okay. So thinking about that question separate from China, I think could be a useful starting point, because things are getting a little muddled. You're asking, what is China's pattern of imports and everything? There's 2 points here. One is that, are we moving to a commodity-based money, and are we moving to a China-based money? And those are not necessarily the same thing. Personally, I think I doubt very much that we're moving to a commodity-based money, because I think credit is a feature, not a bug. Okay, and it may be that politics is trying to move us toward a commodity-based money because we don't trust anybody, and so there's no credit. Okay, in that case, we're in for a very hard time, because credit is a feature, not a bug.
How do you incorporate crypto into all of this?
Well, so we've just seen some crypto meltdown. You know, maybe five years ago in Edinburgh, you may remember we had a little panel about this, and I said cryptos fear credit because it was about Bitcoin then, okay, which is outside money. Okay, no credit. We don't have to trust anybody. We're imagining a world in which we don't have to trust anybody, and that would be an ideal world. And I said, no way, credit is a feature, not a bug. In the last 5 years, the cryptos have discovered credit.
Yeah.
Big time. But without actually paying any attention to the existing experience with credit, and how to manage it and how it can break down. And so we're seeing this with stablecoin now, the collapse of Terra and the challenges that Tether's facing. And so we were talking about this just before you were coming in. I think the desire to have a world in which you don't have to trust anybody. Okay, Bitcoin is a symptom of that. It's not an answer. It's a symptom. And the fact that people want to believe it so badly, okay, is a symptom.
And what's astonishing is they believe it collectively and with a communal enthusiasm, which totally betrays their idea that they're actually going to function on the basis of a lack of trust. In fact, it's a classic insider-outsider group formation mechanism. It actually just demonstrates the complete vapidity of the underlying social theory of the original design. Because in fact, it has value because there is this herding effect of shared enthusiasm, which is far more normal, right? That's actually normal social behavior, but it just invalidates the underlying social model.
Yeah, I mean, I agree with both of you. But then if I understand you correctly, Barry, it's a pimple of dissatisfaction and distrust. Yet something will have to kind of grow out of this distrust, because distrust is in the system, so maybe it's technical speak. But I think I always thought about crypto as a sign of desperation, because there's a speculator in crypto, and then there is those that are really believing it, right? But that's your only chance of accumulating some real wealth, because in the dollar system, traditional, labor, banks, credit, whatnot, you don't have a chance. Which I think is this is about geopolitics and whatnot, but also the domestic income inequality problem is present too. So I think it's these are all manifestations, I think, of all these simmering issues. Yes.
Yeah, it's the frontier and the dream of the frontier where you can make a fortune outside of the existing frameworks. I think I agree with that.
And can I just say one more thing, which is that calls about the end of the dollar always come, right? I mean, again, it's not an end of it, but it's an inflection point. I think the issues are multiplying domestically and globally. So I think this is one of those moments in time where I think.
So let me just quickly ask Adam and Zoltan how tight we are on your schedule, because we have maybe 5-10 minutes left on our original time. Can we do 15? Is that fine with you?
Yeah.
Okay, great. So let's take some questions from the audience. Let's start with Elham and Sasha over here.
Thank you for the presentation. So I was wondering, like, if we move towards commodity-based economy, and so in this case, commodity futures is going to be very important. And do you think like commodity futures have the capacity to absorb all these shocks? I'm thinking of what happened to the nickel commodities recently.
Okay. So, but can I just emphasize? This is like, I think Soros has this analogy of the pendulum. It's always swinging, and like there's that one point, or like rather when you play tennis, and the ball bounces off the ground, and then when it describes that arc, it actually stops up there. But that's when you're supposed to hit it, right? That's your perfect stroke. So we are not talking extremes here. It's not like we go from pure dollar. I mean, we were in pure dollar, but then it's actually not pure dollar because it's a lot of FX swaps. And actually, I can green paper about the stealth erosion of the dollar, because it's not a stealth erosion of dollar. That's just the on-balance sheet manifestation of the fact that you're swapping those dollars. And when you swap it, it's basically a sterling deposit and a euro deposit and right. So you go from pure form, and there's all this stuff in the middle. So we're moving away from this. We're getting closer to that, but it's not going to be an extreme that it's a commodities-based money, right? Because it's not just dollars. It's not this inside, but renminbi inside, and then there's all this other stuff in between. And common sense just would articulate that, dictate that you need more reserves other than just money, right? Because if you go to a shortage economy, so that's that framing it. And then commodity futures, yes. More importantly, commodity futures in renminbi, liquidity there ramping up. I think Dan and Perry wrote this paper about the renminbi a couple of years ago, and I have to revisit that. I think you guys had that nugget there that for a money market to grow up, it has to be tied to some trade commodity related need, and that's commodity markets. Do I remember that correctly? Something.
Dan is here.
I know. I see. I do remember that. Maybe we need to Google it, but in the interest of time, I think more importantly, liquidity will increase in renminbi-based commodity futures at the expense of dollar-based commodity futures.
We'll just move to the next question, Sasha.
Yeah, to me, what's really great about the paper is that it lays out very clearly the assumptions under which this type of future is coming, right? And one can question different assumptions that you make there, but one thing that I feel even at the shortest term we see with inflation is this issue of limiting of the maneuvering space of the monetary policy of Fed. Right? And how important is this to the story, right? Because this is what we see already, right? We see also Janet Yellen saying that we should give up on the trade war protectionism with China in order to fight inflation, right? Right. So we have the interest rate spike, yes, and then we are thinking, and that's working or it's not working, right? But even if it works out in the midterm, right, we are in a world where we know that because of the supply chain issues, inflation is around the corner at any point, right?
Yes.
And the trust that the dollar has is based on the dealership of the Fed.
Yes. Well, yes. Again, this is why I say like this dollar question is a big question, because it is the dollar. The last time the dollar was a big question was in 2008.
Right.
Okay. But then we did QE. But then also that's the point. That's the point in time when China stopped accumulating treasuries. So okay, fine. I start to monetize it, so I don't want this stuff. It's in the data, right? Big inflection point. But 2000 to 08, big run up, flat. I think next is like that. But you printed those dollars. QE was monetary policy for rich people. Huge, the birth of income inequality, right, to the extreme. And then something has changed after COVID, And I'll say that I wrote about this today, so it's fresh in your inbox. And then something changed after COVID, right? Because there is inflation, a lot of inflation. Some of it is goods, some of it is services. Services is domestic, goods is global, supply chain is commodities, whatnot. The services bit, like, where did the people go? There's not, there's so much demand, there's not enough people. Where did the people go? I don't know. The Fed wrote papers about, people falling out of the labor force because of substance abuse. Okay. Too much housing wealth, you retire early. Too much stock wealth, you retire early. Too much crypto wealth, you retire. I'm sure there's other factors that I'm forgetting, but the problem is, and I was in Toronto earlier this week, and I listened to an hour of Elon Musk, future of the auto summit on the FT, and so someone asked him, "Are you worried about your bid for Twitter, is that going to impact sales of Tesla?" And then he said, "No, my problem at Tesla is I have way too much demand. Demand is outstripping supply by a ridiculous amount." So that's the Fed's problem. So, if I'm right about how the Fed is thinking about this, there's a saying that volatility is the best policeman of risk assets. The Fed is talking talk, and the Fed knows what it's doing. But my sense would be that they are in the process of generating a massive round of reverse wealth effects, and they are purposefully doing wealth destruction, right? Because this phenomenon of demand here and supply there, for whatever reason, is extremely inflationary. When wages are rising at 5-6%, I mean, that's your trend inflation, right? Because that's the domestic bit. And again, stocks are down 20%. Rates are up, mortgages are up, but again, this is not, you don't have any visible signs of housing slowing. Rates are up, but they are still below the rate of inflation. And stocks are down 20%, but if the Fed is no longer writing a put option, but a call option, I want it down here, right, to bring things in line. There's a lot more to come. So rates have gone up a lot. I think they will have to go up way more. Think like 4%, 5% in terms of peak. But it's just amazing that everybody that believes in a dollar and dollar assets and risk assets and whatnot approaches this whole hiking cycle as some usual cyclical business cycle. There's a recession, the curve inverts, and we're going to cut. As opposed to one where, I think at least we should think about this, where the Fed is basically proactively, purposefully, by design, engineering reverse wealth effect, because there's just way too much wealth. It's the anti of QE, which, by the way, is going to do things to the dollar once this kind of sinks in, because the dollar is rallying for high. Maybe, maybe not. It's a complex question. Yeah.
So I'm looking in the room. Everybody wants to react. Also, Adam, I'm not sure if you are, but I think I'm thinking of maybe collecting a couple questions now, and then if everybody gets a chance to respond to all of the questions on the table. Can I just get a sign of hands of who has a question so I can see how many we have?
Dan had a question.
Yeah. Okay. Exactly. So let's go with Dan first, and then we go around the room.
So my first question is for Adam, and I don't think you can see me necessarily, but can you hear me? Should I stand somewhere where
Right in the middle?
I can hear you. I can hear you. No, I can hear you very well. I can hear you better than I can hear Zoltan.
Hi,
Hi.
Adam, Dan Nielsen. Quick question.
Hi.
If we are, it seems like there's a lot of agreement that we're in a moment when institutions are changing. And so it seems like we're also at a moment when ideas are changing. And so I wonder if you could think about this as a real-time intellectual history problem. And so could we draw lessons from the time at which Bretton Woods 2 was taking shape institutionally to maybe make some sense of the different ideas or questions that are circulating now before it actually congeals into into a proper form. Thank you. And Zoltan, I'll just say quickly, we can talk afterwards, but I'll just say quickly,
We can't talk afterwards. So
in that paper that you mentioned, I'm attached to the sections with T accounts in them.
yes, yes.
And not the other sections so
Yes,
much.
Yes.
For you, if there's a moment to come to this question, I'd be curious to know where you might see commodities dealers fitting into a world where countries are holding commodity reserves.
Let's
Thank you.
let's actually take those two questions first before we move on. Adam?
I'm still, they're great questions. Thank you very much, Dan. I'm still musing over Zoltan's suggestion that the Fed is engaged in this wealth. I'm trying to figure out what on earth the political economy would be of the American central bank declaring, a deliberate attack on portfolio.
I have an answer.
Right. But let me answer Dan's question, and I'm sure everyone else in the room is curious about that too. But I mean, what's really amazing, it's funny you asked that, Dan, because mine is a slightly indirect answer, but the Hewlett Foundation is right now, and some people may have encountered this, engaged in a deliberate effort modeled on a rather crude understanding of what the Mont Pelerin Society did just after the end of World War II, to do exactly what you're suggesting as a hypothesis. In other words, not only may we be in a moment like the one you're postulating, but significant actors with large amounts of money actually think we are, and are trying to operationalize the idea behind your question as a mode of changing the discourse in the current moment. And they're literally wandering around the country, dishing out these $1 million grants for any reputable university that's able to come up with some kind of alternative to neoliberalism. I mean, it's mind-boggling in its sort of the naivety of its effort to literally carry through on your idea. Hey, what did they do the last time? Let's do that again. Can we spawn this? So if we ever do write the history that way, we will have to incorporate that element of reflexivity.
Thank you. That's a great answer.
Yes, partly to you, partly to Adam. The wealth grab issue. The Roosevelt administration did it because everybody had to surrender gold, and then it got devalued. Number one, and then Nixon did it. And he closed the gold window for good. And Joe Biden just told us this week the number one enemy, and he's 110% supporting the Fed in its fight against inflation, is inflation. Yeah. Slay it, Jay. Okay. And again, what do you think of when you think of wealth? What do you think of wealth as? In the 30s, it was probably gold. Today, it's a 401k plan. To me, what I hear, the Fed say about financial conditions, when the San Francisco president this week says, I want to see more tightness of financial conditions. It means that she's not happy with a 20% decline in stocks. She wants more. I think this is something we need to seriously think about. And then if you overlay, if this is a wartime and this is a shortage economy, then it's like, why should wealth levels and stock prices be where they are? But again, as I've learned, and it always rings in my ears, from Perry, finance is about discounting the future. You have to have a view about this today.
Mm-hmm.
Your portfolio tomorrow. But I think this is something to think about.
All right, everybody who had their hands up can now ask their questions. Go with you first.
Yeah, thanks a lot. My question's for Zoltan. You mentioned at the beginning that there's no evidence in the data that this is happening.
Yes.
But I guess from my perspective, central banks are already shifting their asset allocation away from dollars into Canadian dollars, Aussie dollars, other major exporters too. And they're also buying real assets. They're buying tips, they're buying real estate, which they're not commodities, but they're real assets themselves. So is this not a sign that this is already happening to a certain extent?
So then we'll take the other questions.
Yes.
But Larissa?
So Adam Tooze talked about a commercial logic that sustains the dollar system. If there is a block and there's a new renminbi block, would it be an analogous instrument to the euro dollar that's privatized, stateless, And would China have the appetite for that?
Yeah, it's the CNH, offshore renminbi, right? CNH, CNY, euro. I think that's euro renminbi.
How do we call it then?
Euro renminbi. You just need to grow it.
That's it. But growing it might be complicated.
I mean, it's there.
It's there.
Should we-
And
Should we take the
let me
final?
just- let me just answer that, and then maybe, I mean, I think that's actually quite stimulative the way you asked the question. So maybe a lot of these changes have been happening already. Now it's just that we have a big catalyst that's going to scale it up. But yeah, I think that's a beautiful way of putting it. I mean, when Russia sold the last penny of treasuries they held in 2018, and we went to FX swaps, and the move into gold. I mean, yes, this is, or as Rob mentioned, Chiang Mai, that's another. And the internationalization of the renminbi and the institutional setup of all that and the swap lines, right? That's just laying the infrastructure. Because if there's a moment you want to seize, you can't seize that moment unless you have the grunt work already done. And the grunt work's been done. And all this is an opportunity that you're going to seize. Maybe not. And then you just grow into it, you scale it up. But you can't do anything if you don't have the pipes. The pipes are there.
I'm gonna talk pipes tomorrow. All day. Yeah.
Okay, the very final two questions, and we'll also get to yours in a second. Yeah, go ahead.
Yeah, so there's a paper that came out last month by Michael Dooley.
Yes.
Yeah,
Yes.
you know what paper I'm talking about.
Yes.
So it says the U.S. sanctions reinforce
Yes.
the dollar's dominance. And the idea is that the U.S. produces safe assets that are safe to the world, but they're not safe to bad actors.
Yes.
So the idea is that during times of geopolitical instability, people might want to hold dollar-denominated assets to reassure everyone else that they will behave.
Yes.
So holding dollar assets makes misbehavior too costly. So I'm wondering, what you think about this. They kind of frame it as a collateral against misbehavior risk.
Yes.
Can we get the final question? What do you want to? Can you hold that thought?
Yes.
Clara, you go for the final question.
So thanks. Very interesting. This active wealth destruction, I rather wonder whether we could understand it also more as like an active destruction of the purchasing power of American citizens. And so in this sense, I mean, Duncan Foley, who's now retiring and is a colleague of mine at the New School, he talks about inflation as being about rate of exploitation targeting rather going against inflation rather than inflation targeting is actually rate of exploitation targeting in the sense of both being able to lower the purchasing power of the community and at the same time, of course, this is going to have a big impact, we know, on the fact that right now labor mobilization is rising in many ways. We have unionization, we have the wage increases you mentioned, so that how this will actually have a very immediate effect also on the real economy in terms of also labor relations. So how much do you think this fight against inflation that Powell said yesterday very clearly will cause pain has to do also with kind of trying to stabilize what's going on at the level of the actual labor relations?
Well, first, it's a quote from Tolstoy, which goes something like, that's the exact quote. You can explain the most complicated of things to a slow-witted man, but you can't explain the simplest of things to a man who's already made up his mind. So I didn't read that paper because I'm still in the thinking process and I don't like to read others what I think because I don't like to be influenced too much. But I think there will be the people that chronicle the old, and then there's people that think about the new, and that's like water and oil. I just don't feel like, in great power relations, great powers think about the collateral they hold as well. I'm going to behave because I'm sitting on $1 trillion of treasuries.
All right. Say that I'm in a position of power and I want to reinforce the dollar's dominance. What should I do?
What should you do?
Yeah.
I don't know. guess part of your government is actively pursuing wealth destruction because there's just too much. It's very look. This is very complicated. I have no idea what the answer is. I don't know what the answer is. I mean, clearly, you know, when there is sanctions after another, Russia, China, for, you know, tech supply chain, tech dominance reasons, it's just a very, very complicated picture. I think there's the real manifestation, the industrial manifestation, the monetary manifestation, military manifestation. As to your question, I don't know if I understood this right. You know, yes, there's that labor movement, if you will, right? But I guess, you know, the Fed is just going to have to do whatever it has to kind of bridge this supply demand. You know, clearly demand is way oversupply. So, I mean, that's, you know, the whole unionization and labor movements, right? I mean, that's probably a part of the reasons. Well, for why, you know, there will have to be pain. Because this is not, doesn't appear to me at least that this is a normal business cycle. Like Greenspan used to have these business cycles that he used to manage. It was all in the context of a unipolar world, you know, post-OPEC, dollar on the rise, China on the rise, we import cheap stuff, demand is a bit above supply, okay, so let's do these hikes, cuts and hikes. Opportunistic disinflation, Jesus. We haven't heard that since 2008, and we are, you know, we are trying to, like, I think 90% of the market is looking at this like some opportunistic disinflation moment where we're gonna hike, things are gonna slow down, and then we're gonna cut back down. And yeah, this 20%, this is like peak hiking cycle. It's like time to go long, probably.
Adam, final comments?
I like a lot of what Zoltan's saying. I think it's fascinating. And it seems to me, in fact, to bridge rather neatly the divide between thinking about the future and actually thinking seriously about history, which does involve contemplating precisely what he's just outlined so nicely, the difference between the current moment and previous more orderly cycles. I think that's actually a really insightful and important point. On the more general logic to be inferred from our current moment, I also agree with Zoltan. I'd just formulate it somewhat differently, which is that open warfare, you know, launching large numbers of troops across national borders is very different from sharp-elbowed geopolitical jostling. And they have two very different logics. They have two different types of calculus. And so if, you know, the case that we're seriously worried about, of course, is a Chinese amphibious invasion of Taiwan or some analog of that. And by the time Beijing is contemplating that kind of action, I completely agree with Zoltan. They've written off whatever trillions of dollars are left from their reserve accumulation. That's bygones, that's buried cost. It's irrelevant to that calculus. In the same way as I think ultimately, though the Russians may have been surprised by what we did, also their calculus in Ukraine was, insofar as we can actually reconstruct a calculus that was involved, just doesn't conform to any simple kind of cost-benefit analysis, because that just doesn't, I think, help make sense of the world. And our models mislead us and are not very helpful if they're not able to distinguish between those two, you know, sort of phases or states of power politics. They both involve power. They involve threats in the one case of hard power and actual launching of it. And that creates a new situation. And that will be another way of agreeing with Zoltan that one of the things that's different about our current moment is that though Russia may not be at the heart of everything, we are in the middle of an actual war. And that makes this different. And it is not a war like 2003, and it's not a war like Kuwait 1 either, because the outcome of this war for both parties is in fact existentially uncertain. We don't know how this is going to end. And that's very different from previous large-scale military encounters over the last 30 years or so. And all of that creates a level of contingency in the power system that's radical and novel.
Rob, final word.
As I'm sitting here, you know how the birds sing to me. I have a song that describes tonight. It's by a group called Buffalo Springfield. really own Stephen Stills. It's called For What It's Worth. There's something happening here, and what it is ain't exactly clear. Tomorrow, we have a chance to have another seminar, and I'll invoke Simon and Garfunkel, because you got to bridge over troubled waters. Thank you all. This was good.
I need to thank Adam and Zoltan for a great session, and everybody that's been on the Zoom call. So just to leave you with a final thought as well, and the, sort of in the spirit of Elham, YSI is like money, but we're like about credit, about trust. We need that in the community, and also for us to have a good time, we need some liquidity. So let's go upstairs and have a drink. So thank you very much. Bye, everybody over there.
Bye,
See you later.
Adam.
Bye, bye, bye. See you.